Hey guys, wanted to go through some just general economics data with you. A lot of times there's a lot of people that get on YouTube. They love to uh, argue or just kind of counter against, you know, someone who has taken the time to really do their due diligence to share information, and they kind of bring forth sometimes not the most credible arguments. Okay, and those arguments, again, where research hasn't been put in, can directly impact and influence everyone's thoughts and decisions. So let's bring the real true accuracy on this. Let's see where the truth lies, okay? So that no one's misled, okay? Because people are making claims about my last video, and so let's use factual data to kind of reflect the truth here, okay? So let's start off with inflation, okay? Near the top here says the impact inflation has on the value of money is that it decreases the value of the dollar. So they're telling you there, higher inflation decreases the value of the US dollar. Okay, well, let's see where the US inflation currently is. So right now, the US inflation is a little bit on the higher end. In 2020, it's at 2.3%. Okay, that's a little bit on the higher side. So based on, and again, that's why I told you, remember I said we needed a market correction to bring our markets down. I didn't say anything about the value of the US dollar in that. I said the markets were too high. They needed to come down to reduce inflation, because as you see right there, inflation was climbing up towards 3% where it was in 2011, okay? But again, higher inflation weakens the value of the US dollar, okay? Now, let's look at what some people had shared, and let's see how accurate their information is compared to real, true, factual data. Okay, John Hubbard said that market watch showing the dollar index that I shared with you guys. He goes, that's an index to show the trade value of the dollar against a series of other currencies. They simply climb because the others are falling. I have to disagree with that, John, because what the dollar index does is what it's reflecting is the overall whereabouts of the U.S. economy, and whether the U.S. economy is strong or weak is what impacts the value of the U.S. dollar. See, John, there in your last one, you're saying that's the beauty of being a reserve currency. If you're a reserve currency, which the dollar is, the euro is a reserve currency. If the euro collapses, that only has a very minute, minimal impact on the dollar. Overall, John, what's going to strengthen the value, or what shows the true value of the US dollar based on the dollar index, really doesn't have anything to do with other foreign currencies. It has to do with the exact status of the US economy. Again, it's all based on the US economy, not what the euro's done. If the euro collapses, that's impacted by what's happening in Europe, and Europe's economy impacts the value of the euro. Okay, so if the euro takes a crap and collapses, that's not really going to drive the value of the US dollar up. I mean, you won't even really notice it, guys. The strength or value of a country's currency is really based on what's happening within that country's economy. Okay, so John, I strongly have to disagree with you there, bud. In fact, John, we're going to get into some hard factual data that's going to prove your claims to be significantly incorrect here. Now, Chris Manning, you said the other day that I said that the virus had to drive down the U.S. markets to ride the wave back up, and that's true. But I didn't say anything about the value of the U.S. dollar in that statement. Okay, all I was telling you is that the markets needed to come down. Okay, the markets needed to come down so that when the markets actually go up, okay, it doesn't spike inflation. That was really what I shared to you. So I'm not sure why you're bringing the dollar in with my market statement. I didn't bring a direct relationship in with the dollar. All I spoke about was the markets, not the dollar. So anyway, let's get into the real true economics on this, guys. Let's see what the driving factors are for the US dollar. Okay, So here's three factors that drive the US dollar. First one, guys, is supply and demand. All right. So when the US export products and services, it creates demand for the dollar because customers need to pay for goods. So remember, guys, Obama kept the value of the US dollar really high. Okay, that actually weakened the US economy. Or for the most part, Obama was keeping the value of the dollar well above 100 cents. That was weakening the US economy because it made it harder and it made it more costly for outsiders to do direct import export business with the US because the value of the US dollar was very high. And that's why when Trump came on board, he brought the value of the dollar around kind of around 94 to 98 cents. That was his prime range, or that's where that's where Trump liked to keep the dollar, okay, to make it more cost effective to do import X. So guys, I can tell you right now, Trump does not want the value of the dollar even over really 98 cents right now, because that directly impacts the strength of our economy. Okay, that makes it very hard for other countries and outsiders to do direct import and export with the U.S. because the value of the dollar has a higher cost to it. So it costs outsiders significantly more money to be able to do business and import and export and trade. So that's why Trump's always kept it around 94 to 98 cents. So right there, supply and demand. Let's look at the next one. The sentiment of the market psychology of the dollar value. Let's look at that for a second. Okay, it says, in the case of the U.S. economy weakens and consumption slows down due to increasing unemployment, guys, we have all of that happening right now. We have a weakening economy. Our economy's slowing down, and unemployment's going to start spiking up. Okay, and those variables, okay, should weaken the U.S. dollar. Okay, so again, slowing economies, increasing unemployment, all of that weakens the U.S. dollar, and that's the direction that we're headed right now. But yet the value of the U.S. dollar is shooting through the roof. Now let's look at the next one: technical factors that impact the dollar. Traders are tasked with gauging whether the supply of the dollar will be greater or less than the demand for the dollar. To help determine this, we need to pay attention to any news and events that impact the dollar's value. That includes the release of various government statistics such as payroll data, GDP data, and other economic information, okay, to see if there's weakness in the economy, guys. So with payroll data, soon we're going to have our unemployment rate's going to be increasing. So there's your payroll data. Our GDP data is going to start looking like crap right now because of our economy's in the chutes. Our economy's upside down. So my point is this, guys, there's nothing in here, as you see here for economic data, there's nothing in here talking to you about the value of another country's currency, guys. The value of the U.S. dollar is impacted by what's happening within the U.S. economy. It doesn't have anything to do with where the euro's at, okay? And let's look at these last two lines. It says bringing factors together. Traders typically adopt some combination methods we've outlined above to make their buy and sell decisions. The art of trading exists in stacking the odds in the form of congruence and three methodologies in favor of building an edge. If the probability of being correct is high, the trade will assume the risk of entering the market, managing their hypothesis accordingly. Okay, here's an example of a dollar shift. The economic conditions during the recession that began in 2007 forced the U.S. government to play an unprecedented role in the U.S. economy, since economic growth was receding as a result of large deleveraging the financial assets. The government had to take up the slack by increasing spending and propping up the economy. The purpose of government spending was to create jobs so that consumer could prop up their economy. The purpose of government spending was to create the jobs so that the consumer could earn money and increase consumption, thereby fueling the economy needed support growth. So the government took this position at the expense of increasing the deficit, the national debt. In short, the government essentially printed and sold government bonds in foreign governments, and investors to increase the supply of the dollar, resulting in the country's depreciation. So guys, those are the economic factors that really impact the value of the U.S. dollar. There's nothing in here about the value of other currencies. Okay, it's all based on what's happening within the U.S. economy. As you guys see, there's nothing in our economy right now happening to justify the value of the U.S. dollar shooting through the roof. Our markets are too weak right now. Okay, layoffs are going to start occurring. Okay, our economic data is very bad. The value of, based on all this data I presented to you, the value of the U.S. dollar should not be rising to where it is. And let's take one more look at it real quick. Let's see where it's at right now. Let's see where the value of the U.S. dollar is. Okay, guys, it's earlier I was watching it. It was at 102, but anyway, so there's the value of the U.S. dollar. So now that you guys have a good, clear understanding of what economic data is the driving factor for the U.S. dollar. Again, strong jobs, strong financial markets, not what the value of the euro is, Mr. John. Sorry, bud. But anyway, guys, that's what drives. And the U.S. dollar is more of a reserve. It's kind of an indexing, meaning other currencies are pegged to it. But the euro itself is a primary currency too. So primary currencies don't have a huge relationship on another primary currency value. Currencies are independent, but currencies are based on their own country's economic data. If a country, guys, this is very simple. There isn't much to this, okay? If a country has a weakening economy and job layoffs and so forth, that's going to weaken that country's currency. It's that simple. There's no, you can't say, oh, well, because of the euro that, no. It's the individual economic data from within that country that is the driving factor for that country's currency. That's what this facts will prove to you guys. So there you go. Be careful. Guys, be very careful what you post. If you're going to post inaccurate data, you're going to mislead everyone, and that's just not fair to everyone, okay? Especially when someone who has taken the time to really do a lot of research and bring it forth, and then you come out saying, oh, well, because the euro's weak, it's going to weaken the dollar. I mean, guys, that's just sad. That just shows that you haven't done your due diligence, So anyway, guys, God bless. Have a great day.